Nicosia, March 2013. It is Saturday morning, and the first sign that something is wrong is not a headline. It is a machine. A man walks to an ATM to pull out cash for the weekend. The screen is dark. The bank doors are shut. Inside the building, the money still exists on paper. On his phone, perhaps it still exists as a balance. But in the only sense that matters during a banking panic, usable, transferable, reachable, it is already beginning to disappear. That was the psychological break in Cyprus, not the parliamentary language, not the emergency meetings in Brussels, not the legal memoranda drafted behind closed doors. The break came when ordinary depositors understood, in real time, that a bank account is not the same thing as possession. Cyprus's authorities declared bank holidays in March 2013, and when the system reopened, it did so under capital controls and withdrawal restrictions. At Bank of Cyprus, 47.5% of uninsured deposits were ultimately converted into equity. The saver who thought he held cash discovered he held exposure. That distinction sounds academic right up until the weekend you need rent, payroll, medicine, or the ability to move your own funds across a border. And this is why Cyprus matters far beyond Cyprus, because the event was not just a local banking accident. It was a public demonstration of a new doctrine. When a large bank fails, the state will try to preserve the institution without necessarily preserving every depositor's freedom, timing, or principle above the protected line. That logic was later formalized across major jurisdictions to post-2008 resolution frameworks designed to shield taxpayers by imposing losses on shareholders and unsecured, uninsured creditors first. So the real subject of this video was not Cyprus. It is the moment your savings stop being property in your mind and start being a liability on someone else's balance sheet. The first deception in modern banking is linguistic. People say, "I put my money in the bank," as if they were describing storage, as if there is a vault somewhere, a labeled shelf, a neat little compartment containing their labor in preserved form, waiting to be reclaimed on demand. That is not what a deposit is. Legally and operationally, your deposit is a liability of the bank. On your personal balance sheet, it appears as an asset. On the bank's balance sheet, it appears as money the bank owes you. The system works because most days that distinction does not matter. Your card works. The wire clears. The salary arrives. The ATM lights up. But once confidence breaks, the legal structure underneath the convenience suddenly becomes the entire story. The Bank of England's own explanation of modern money is explicit that bank deposits are bank liabilities. And the FDIC's failure framework is equally clear that uninsured depositors sit in the creditor waterfall after insured deposits are protected. That means a depositor is not outside the bank's risk. A depositor is inside it. You are not merely using the bank's plumbing. You are funding the institution. Your account balance is, from the bank's perspective, part of the structure that keeps the balance sheet standing. In ordinary times, that sounds harmless. In stress times, it becomes the reason access can be frozen, rationed, transferred, guaranteed, haircut, or converted depending on where you sit in the hierarchy and how much political room the authorities still have. The FDIC has stated plainly that uninsured deposits are a form of unsecured credit, which is a sterile phrase for something much more human. Above the insured line, you are no longer standing on the floor. You are standing in the structure. This is why banking crises are so psychologically violent. A stock investor knows, at least in theory, that prices can fall. A bondholder knows, at least dimly, that default exists. But the ordinary depositor has been trained to think in terms of access, not exposure. He does not experience his checking account as an investment in bank solvency. He experiences it as cash with a password, and that illusion holds until a Friday evening announcement, a weekend closure, and a Monday morning line around the block. Then the categories split apart. Insured funds may be transferred quickly to an assuming institution or made available by the deposit insurer. Uninsured funds enter a different reality: receivership, recovery values, liquidation proceeds, dividends, legal priority. The vocabulary alone tells you what has happened. The customer has been reclassified as a claimant. The savings account has become a case file. The FDIC's own explanation of failed bank resolution notes that insured depositors generally regain prompt access, while payments on uninsured amounts depend on what is recovered from the failed bank's assets and paid according to statutory priority. And once you understand that, Cyprus stops looking like an exotic exception. It begins to look like a tutorial, because the real lesson was never simply that depositors lost money. The lesson was that the law had already decided what a depositor was. After 2008, officials around the world promised that the age of taxpayer-funded bank rescues would end. That promise was politically useful, morally satisfying, and only partially true. What actually happened was more precise. The system was redesigned so that a failing bank could be stabilized by consuming losses from inside its own capital structure before the state openly reached for the public balance sheet. In 2011, the Financial Stability Board adopted the key attributes of effective resolution regimes for financial institutions, and the G20 endorsed them that November as the new international standard for bank resolution. The central idea was continuity without classic bailout. Keep critical functions running, preserve financial stability, but impose losses on investors and eligible creditors according to a legal hierarchy. That sounds technical. In practice, it means the state changed the emergency script. Before, the public watched governments recapitalize broken institutions with taxpayer support because the alternative looked even worse. After the official goal became resolution rather than rescue, shareholders get wiped or diluted. First, subordinated creditors absorb losses next, and then other unsecured liabilities can be written down or converted if necessary to recapitalize the institution and keep the essential machinery operating. The bank may survive in some form. Payments may continue in some form. Branches may reopen in some form. But the people funding that continuity are no longer assumed to be the public. This is where the phrase bail-in enters the story. In Europe, that post-crisis logic was written directly into the Bank Recovery and Resolution Directive. The European Commission's own summary is blunt. The EU implemented the international consensus that banks should not again be bailed out with public money, but instead should be bailed in, with internal loss-absorbing capacity covering the cost of failure. The directive created a formal tool allowing liabilities to be written down or converted in resolution, subject to exclusions and creditor hierarchy. The European Banking Authority's guidance on bail-in is equally clear, that the process follows the sequence of claims and is meant to absorb losses and recapitalize the bank in resolution. Cyprus was the public rehearsal because it turned this doctrine into lived experience, before most depositors in other countries had even heard the term. The authorities did not merely announce a banking problem. They demonstrated a new order of sacrifice. Insured deposits were treated differently from uninsured deposits. Access was restricted through capital controls. Large balances were trapped long enough to be used as part of the recapitalization mechanism. What ordinary people saw as savings, the resolution logic saw as a layer in the liability stack. That was the real innovation, not confiscation as spectacle, but creditor ranking as policy. The United States military states reader statutory language, but the direction was parallel. Under Title II of the Dodd-Frank Act, the FDIC developed its single point of entry strategy for resolving a systemically important financial institution. The stated goal is orderly resolution that preserves critical operations and avoids taxpayer bailouts. Losses are imposed on the failed firm's shareholders and certain creditors, while operating subsidiaries can continue functioning through a bridge structure. In other words, the choreography differs, but the principle is familiar. Continuity of the institution's essential functions does not mean continuity of every claim against it. So when officials say the system is safer because bailouts are less likely, hear the sentence more carefully. Safer for whom? Safer for taxpayers, as a political category perhaps. Safer for the continuity of the payment system. often, but not necessarily safer for the large depositor, the treasury manager, the business with concentrated cash, or the family that assumed bank money and sovereign money were functionally the same thing under stress. The post-2008 reform did not abolish loss. It assigned it in advance. Now we reach the most comforting phrase in modern banking, and therefore one of the most dangerous when misunderstood. Your deposits are insured. That sentence is not false. It is incomplete. Deposit insurance is real, useful, and worth respecting. In the United States, the standard FDIC limit remains $250,000 per depositor, per insured bank, per ownership category. Federally insured credit unions use the same standard through the National Credit Union Share Insurance Fund. In the European Union, the harmonized protection level remains €100,000 per depositor, per bank under deposit guarantee rules. In the UK, FSCS protection rose to £120,000 per eligible person, per authorized firm on December 1, 2025. With temporary high balance protection up to £4 million for 6 months in certain cases. All of that matters, but insurance limits are not the same thing as systemic immunity. They tell you the rule for an account. They do not tell you what happens when many institutions fail at once, when payment systems are strained, when resolution capacity is overwhelmed, or when authorities decide ordinary rules are politically impossible to apply cleanly. In 2023, after Silicon Valley Bank and Signature Bank failed, the FDIC invoked the systemic risk exception and protected uninsured depositors while recording large related losses and a special assessment on banks to recover the cost. That was not proof that all money is always safe. It was proof that, in a sufficiently dangerous moment, the government may step outside the normal template because the normal template is too destabilizing to enforce in full. So the mirage is not deposit insurance itself. The mirage is the assumption that a posted coverage number solves a civilization-scale liquidity problem. It does not. Insurance is a line of defense. It is not a substitute for structure, timing, diversification of banking relationships, or immediate access outside the banking system. And when confidence breaks, access becomes the first scarcity, long before the legal paperwork catches up. So how do you read danger before the screen goes dark? Not by waiting for a rumor, not by staring at the stock price alone, and not by trusting the phrase well capitalized as if it were a force field. Start with a simpler rule. Banks usually fail slowly on paper before they fail suddenly in public. The public phase is the line at the branch, the frozen transfer, the emergency statement. The private phase comes earlier. It shows up in the composition of assets, the quality of funding, and the distance between reported capital and economic reality. The first red flag is concentrated uninsured deposits. When a bank relies heavily on large commercial or affluent depositors above the insured threshold, it is living on confidence that can move at digital speed. That was one of the central lessons in 2023, and regulators have spent the period since emphasizing the instability of rapid deposit outflows in a connected banking system. The second is large, unrealized losses on securities. A bank can look adequately capitalized under regulatory measures while sitting on long-duration assets that lose market value when rates rise. If deposits remain stable, the problem can stay hidden. If depositors demand cash, those paper losses can become real very quickly. The FDIC's quarterly banking profile continues to track unrealized gains and losses on investment securities, precisely because they matter when liquidity turns into a forced sale problem. The third is thin capital relative to the well-capitalized thresholds. Under U.S. prompt corrective action standards, well-capitalized begins at defined levels, including a CET1 ratio of 5%, Tier 1 risk-based capital of 8%, total risk-based capital of 10%, and a Tier 1 leverage ratio of 5%. But thresholds are floors, not prophecies. A bank hovering near the minimum can still be legally well capitalized, while becoming strategically fragile. So the practical question is not whether your bank is safe in the abstract. It is whether its funding can stay put, its assets can stay money good, and its capital can survive a weekend of fear. So what actually changes the legal character of your cash? Only two moves matter. First, cash you physically control, not because paper notes are magical, and not because they are risk-free. They can be stolen, destroyed, or eroded by inflation. But because they are no longer a commercial bank deposit, they are not sitting as an unsecured claim on a private bank's balance sheet. Central bank-issued notes are a different form of money from commercial bank deposits, and that distinction matters most when access fails. Second, assets held outside the banking liability chain in properly allocated non-bank custody. The key word is allocated, not pool promises, not omnibus exposure you do not understand. Title, segregation, and retrieval terms matter more than branding. That leads to the scorecard. Grade your bank on 5 points: uninsured deposit concentration, unrealized securities losses, capital buffer above minimums, dependence on brokered or flight-prone funding, and your own percentage of cash held above insurance thresholds. Low score, convenience. High score, dependency. I score, dependency. The forensic record gives one conclusion. In stable times, bank balances feel like money. In unstable times, only direct control and clean title still behave like money. That is the choice. Trust the interface or prepare for the structure.